Good morning, everyone, and welcome to the General Dynamics first quarter 2021 earnings conference call. All participants will be in a listen-only mode. Should you need assistance, you may signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star and 2. Please also note today's event is being recorded. At this time, I'd like to turn the conference call over to Howard Rubell, Vice President of Investor Relations. Sir, please go ahead.
Thank you, operator, and good morning, everyone. Welcome to the General Dynamics first quarter 2021 conference call. Any forward-looking statements made today represent our outlook. These estimates are subject to some risks and uncertainties. Additional information regarding these factors is contained in the company's 10 and 8K filings. With that completed, I'd like to turn the call over to our Chairman and Chief Executive Officer, Phebe Novakovic.
Thank you, Howard. Good morning, everyone, and thanks for being with us. As you can discern from our press release, we reported earnings of $2.48 per diluted share on revenue of $9.4 billion, operating earnings of $938 million, and net income of $708 million. Revenue is up $640 million, or 7.3% against the first quarter last year. Operating earnings are up $4 million, and net earnings are up $2 million. To be a little more granular, revenue on the defense side of the business is up against last year's first quarter by $444 million, and aerospace is up $196 million. The defense side are up $45 million, or 6.4%, while operating earnings in the aerospace side are down $20 million, but still nicely above consensus. I will have more to say about this a bit later. The entire company was 10%, 70 basis points lower than the year-ago quarter. This was driven by a 250 basis point lower margin rate at aerospace, as was fully anticipated in our guidance to you, combined with $21 million more in corporate operating expense. From a slightly different perspective, we beat consensus by 18 cents per share. We have roughly $500 million more in revenue and almost $50 more in operating earnings, so it's a pure operations beat. I must confess that we were also beat handsomely. This is, in almost all respects, a very solid quarter. It's hard to find something not to like about it. So let me move right into some color around the performance of the business segments, have Jason add color around cash, backlog, taxes, and deployment of cash, and then we'll answer your aerospace. Aerospace enjoyed revenue of $1.9 billion and operating earnings of $220 million with operating margins. Revenue is almost $200 million higher than anticipated by us and the sell side. Revenue is higher than the year-ago quarter. The difference is almost exclusively more G500 and G600. The 11.7% operating margin is lower with our guidance and sell side expectations. Finally, we took some mark-to-market charges with respect to our G500 test inventory. Without the charge, from a pure operating perspective, performance in the quarter was superb. Aerospace also had a very strong quarter from an orders perspective with a book-to-bill of 1.3 to 1. Gulfstream alone had a book-to-bill of 1.34 to 1. In unit terms, this is the strongest order quarter for the last 2 years, excluding the fourth quarter of 2019 when we launched the G700. The sales activity truly accelerated in the middle of February and continued on through the remainder of the quarter. The momentum developed in the quarter appears to be rolling over into the second quarter as well. We are experiencing a high level of interest and activity. It is constructive to see this accelerated activity level without the benefit of the removal of travel restrictions and quarantine requirements in many countries outside the U.S. Demand should improve even further when these restrictions are ultimately removed. Gulfstream experienced a 5.7% increase in service revenue. On the other hand, Jet Aviation's FBOs and certain of its maintenance facilities are recovering more slowly. Jet Aviation service revenue is down around $31 million, coupled with a modest increase in service operating earnings. The FBOs and MRO sites will do much better as business travel accelerates. The G500 and G600 continue to perform well. Margins are improving on a consistent basis and quality is superb. As of the end of last week, we have delivered 104 of these aircraft to customers. The G700 has over 1,400 test hours on the 5 test aircraft, and the first fully outfitted G700 is flying. Its interior is absolutely beautiful. We remain on track for entry into service in the fourth quarter of 2022. Looking forward, we expect the second quarter to be our most challenging from a delivery perspective. However, we also expect rapid improvement in the third and fourth quarters as we had planned for an increase in production and more deliveries. Combat Systems. Combat Systems has revenue of $1.8 billion, up 6.6% over the year-ago quarter. While all 3 companies within the group contributed to the growth, the primary source was increased sales of our 8x8 wheeled combat vehicles to Switzerland and Spain, and sales of our 6x6 Eagle vehicles. So all in all, good growth. It is also interesting to observe that Combat Systems revenue has grown in 16 of the last 18 quarters on a quarter-over-the-year-ago quarter basis. Operating earnings at $244 million are up 9.4% on higher volume and a 30 basis point improvement in margin. This was an impressive performance by any reasonable measure. You may recall that a notable development for this segment in the year-ago quarter was the formal signing of the restructured contract on the Canadian International Program, which settled all issues. The parties continued to perform on that contract as contemplated. This was helpful to free cash flow last year and continues to be so this year. This risk item appears to be behind us. Turning to Marine Systems. You may recall that at this time a year ago, I was able to report that revenue in the first quarter of 2020 was up 9.1% against the first quarter in 2019. I am very pleased to report today that first quarter 2021 revenue of $2.48 billion is up 10.6% against first quarter 2020. The growth was led by Block V Virginia-class and Columbia-class construction volume. We also enjoyed nice increases in ESB and TAO construction volume at NASSCO. This is very impressive continued growth. In fact, revenue in this group has been up for the last 14 quarters on a quarter versus the year-ago quarter basis. Operating earnings are $200 million in the quarter, up $16 million or 8.7% on an operating margin of 8.1%. We will strive to improve our operating margin as we progress through the year. On the order side, I should observe that total backlog was down only $231 million sequentially, leaving a powerful $49.8 billion in total backlog. There was obviously significant order activity in the quarter, including the award of the 10th Block V Virginia-class submarine. Finally, Technologies. This segment had revenue of almost $3.2 billion in the quarter, up $95 million from the year-ago quarter, or 3.1%. The revenue increase was supplied by information technology, mostly associated with the ramp-up of new programs. IT alone grew 5% in the quarter. Operating earnings at $306 million are up $8 million or 2.7% on a 9.6% operating margin. This is about 40 basis points ahead of consensus. EBITDA margin is an impressive 13.3%, including state and local taxes, which are a 50 basis point drag on that result. Most of our competitors carry state and local taxes below the line. This is a best-in-class EBITDA margin. Total backlog grew $359 million sequentially, and total estimated contract value remained about the same. There were also some notable items in GDIT's first quarter worth mentioning. On the bid and proposal front, GDIT submitted the highest dollar value of proposals in any quarter since the acquisition of CSRA, 90% of which represent new business opportunities. They ended the quarter with over $30 billion in proposals awaiting customer decision, most of which also represent new business opportunities versus recompetition of existing work. So good order activity in the quarter with a book-to-bill of 1.1 to 1 and good order prospects on the horizon. That concludes my remarks with respect to a very good quarter. As you know, we never update guidance at this time of the year. We will, however, give you a comprehensive update at the end of the second quarter, as is our custom. I'll now turn the call over to our CFO, Jason Aiken, for further remarks, and then we'll take your questions.
Thank you, Phoebe, and good morning. I'll start with our cash performance in the quarter. From an operating cash flow perspective, we essentially broke even for the quarter. Including capital expenditures, our free cash flow was negative $131 million. For those of you who followed us for some time, you know we've been a fairly significant user of cash in the first quarter for the past several years. This quarter was a marked improvement from that pattern, due in large part to the strong order activity at Gulfstream and ongoing progress payments on our large international combat systems program, consistent with the contract amendment Phoebe referenced earlier. So the quarter was nicely ahead of our expectations and reinforces our outlook for the year of free cash flow conversion in the 95 to 100% range. Looking at capital deployment, I mentioned capital expenditures, which were $134 million in the quarter, or 1.4% of sales. That's down between 25 and 30% from the first quarter a year ago, but we're still expecting full-year CapEx to be roughly 2.5% of sales. We also paid $315 million in dividends and increased the quarterly dividend by a little more than 8% to $1.19 per share. And we spent nearly $750 million on the repurchase of 4.6 million shares at an average price of just over $161 per share. After all this, we ended the first quarter with a cash balance of $1.8 billion and a net debt position of $11.4 billion, down $1.3 billion from this time last year. Net interest expense in the quarter was $123 million, up from $107 million in the first quarter of 2020. The increase in 2021 is due to the incremental debt issued last year in conjunction with the refinancing of maturing notes. We have $3 billion of outstanding debt maturing later this year, and we plan to refinance a portion of those notes to achieve a more balanced deployment of capital, but this will still result in a declining debt balance this year and beyond. During the quarter, Congress passed the American Rescue Plan Act. As you may be aware, it contains two provisions that affect our business. First, it extends the provision of the CARES Act that allows reimbursement of contractor payments to workers who are prevented from working due to COVID-related facility closures. This will continue to benefit our technologies business, although it does not provide for fee on those costs, so that will have an ongoing dilutive impact on the segment's margins. Relief by reducing the amount of required contribution to our pension plans this year by a couple $100 million. However, this same provision reduces the amount of pension costs we're reimbursed on our U.S. government contracts. As a result, when coupled with the lower tax benefit from the reduced pension contributions, the impact on our 2021 cash flow is immaterial. We expect the cash benefit from the Act to increase modestly over the next couple of years, reinforcing our expectation that free cash flow can exceed 100% of net income over that period. The tax rate in the quarter at 16.2% is consistent with our full-year expectation, so no change to our outlook on that front. Finally, order activity and backlog were once again a strong story in the first quarter, with a 1-to-1 book-to-bill for the company as a whole, even as we grew by more than 7% in the quarter. As Phoebe mentioned, the order activity in the Aerospace and Technologies groups led the way with a 1.3 times and 1.1 times book-to-bill, respectively. We finished the quarter with a total backlog of $89.6 billion. That's up 4.5% over this time last year, and total potential contract value, including options and IDIQ contracts, was $131.4 billion, up 6% over the year-ago quarter. Howard, that concludes my remarks. I'll turn it back over to you for the Q&A.
Thank you, Jason. As a reminder, we ask participants to ask one question and one follow-up so that everyone has a chance to participate. Operator, could you please remind participants how to enter the queue?
Ladies and gentlemen, at this time we will begin the question and answer session. Once again, to ask a question, please press star and then 1 using a touch-tone telephone. To withdraw your questions, you may press star and 2. If you are using a speakerphone, we do ask that you please pick up the handset before pressing the numbers to ensure that you join the question queue. Once again, that is star and then 1 to join the queue. And we do ask that you please limit yourselves to a single question and 1 follow-up. Our first question today comes from John Raviv from Citi. Please go ahead with your question.
Hey, good morning, everyone. Thanks. Question on GDIT. The path, I think you guys had talked about 7% growth this year. You did 5% in the first quarter, so definitely a good start. So any kind of milestones to look upon there. And then just overall commentary on the environment. We've heard of some delays and slowness in awards. Some other contractors have been highlighting some disruptions that's impacting organic growth. So any view as to how that's impacting your 21 and how that could flow out over 22 as some of these new businesses, as these new awards come through?
So as I noted, we submitted a very large number of proposals in the quarter, and we're awaiting over $30 billion in customer decisions on contracts. And COVID obviously had some impact on that decision-making process, but we expect that as the government gets back to full operating cadence, that we will begin to work through some of that backlog on the order decisions. And with respect to milestones, really, if you think about it this way, this is such a large business with 7,000 contracts. There really aren't any external milestones to necessarily look for. But we were very pleased and not surprised with the growth that they exhibited. And frankly, the fact that many of their new program wins, were the major factors behind the increase. So all in all, we look to be in pretty good stead.
And then thank you, Phoebe. And then just a brief follow-up, again, sticking to the technology and maybe also IT market. When you look at this huge, almost backlog of things to be adjudicated, you mentioned that a lot of it is new business. Would you consider a lot of this new business to be yours, or is this some element of white space almost with the government creating and doing more things that are contractor addressable?
So I think it's a combination. I think fair share. Number one. Number two, the government is combining a number of pre-existing current workload into larger contracts, given that the scale and magnitude of the effort that's required, again, is a good thing for us to bid on those large contracts. And then some of it is just pure program wins. So I think that's pretty much how we see that market unfolding.
Thank you very much.
Our next question comes from Seth Seifman from J.P. Morgan. Please go ahead with your question.
Thanks very much, and good morning.
Seth?
I was wondering if you could, I think you mentioned some inventory write-downs on G500. I was wondering if you could quantify that, and just so we could have a cleaner look at the aerospace margin.
Yeah, so we're not in the habit of giving detailed product-by-product margin. We did have a mark-to-market on some of our test airplanes on the 500 test airplanes, which is pretty much to be expected with test airplanes. But we see that as, so I noted that some color that absent that we would have seen even better operating performance.
Right. I guess maybe without quantifying it, is there the trajectory of margins at aerospace we should expect through the year and sort of as we go into Q2?
So we expect, as I noted, delivery margins to be compressed in Q2, but increasing nicely then quarter over quarter and into Q4. But recall, we have noted before that we see 2021 as our lowest margin year for all the reasons that we noted, not the least of which is we took out 10 airplanes, largely as there was, in our production last year, largely as there was 50 production and some mid-cabin. So when freezer increasingly picks up, then we ought to see some return to what we had considered our normal production rates and hence delivery rates. So that'll drive margin.
Okay. Thanks.
Particularly going into next year, you can't discount the impact of the entry into service of the 700.
Our next question comes from Callan. Please go ahead with your question.
Yes. Thanks so much. Good quarter feed. More color on demand at Gulfstream. First, what are we looking at in terms of corporate demand, which we've heard is still weak, and ultra high net worth, which we've heard is very strong. And, any color on specific models, like I think you said you had 70 orders for the G700. Is that number, moving up at a decent pace?
In the inverse order, yes, that number is moving up with respect at a good pace. With respect to the balance in this quarter order activity, it really was a broad section across all buyers. We're beginning to see some of the big Fortune 500s re-enter the market space as clarity around the U.S. economy increases. And to that end, the U.S. had and accounted for more than half of this quarter's orders. So look, if you think about demand, as we see the lifting of the international travel restrictions and removal of quarantine restrictions, and the increased confidence of obviously the U.S. economy, but also global economies, we expect to see demand continue to increase. And should it, we see Gulfstream as being in very good stead.
So you mentioned, demand getting better, and we know that to come down, and we have the weird situation where all of these routes are not opening up. Given the strength in demand, if you wanted, or if the demand were there to sort of deliver more planes, how long would it take you to kind of operate so that we can see those deliveries moving up?
So on average, it takes about 6 months. We're looking at just a few more production airplanes, as I noted in my remarks, to adjust and be sufficiently agile as we see demand continue to increase. So I like how we balance prudent yet full. And we are pretty efficient when it comes to ramping up, but it does take a lead time of about 2 quarters.
Thank you.
And our next question comes from David Strauss from Barclays. Please go ahead with your question.
Thanks. Good morning.
Good morning, David.
Phoebe, wanted to follow up on some of your earlier comments around the margin in Gulfstream. So, over time we got used to this being a mid to high teens business. Is that still the right way to think about this business going forward, particularly when the 700 comes in? And do you expect the 700 to be margin accretive when it starts to deliver?
So the 700 will be margin accretive when we begin deliveries. We think about this on given our portfolio and our place in the firmament as a mid-teen margin business for the short term. But as you can imagine, we'll continue to work margins. And as we've talked about many times before, driven by a whole host of issues, not the least of which is service mix. And when we were hitting our apex of margin a couple of years ago, that was, as you recall, an acceleration of the 650 backlog, which had a salutary effect of better aligning 650 demand with the backlog, so there wasn't too much of a wait for people, but also helping us transition through that period when we were replacing the 450-500 or 450-550 with 500 and 600. So that is largely behind us, and we, as I said, expect to see some nice margin accretion as we go forward.
Great, that's helpful. And Jason, could you comment a little bit on the moving pieces of capital and what to expect there? Inventories come down a bit, advances, have been a bit of a headwind. So just, how we should expect the different pieces within working capital to move from here. Thanks.
Sure. You'll recall the major moving pieces that we've talked about sort of outside the normal run rates for the business in general have been the elevated inventory level at Gulfstream as we've invested in the new models between test airplanes and the buildup for production and entry into service. That obviously has been a headwind for several years now. We saw that start to turn at the end of last year, a little bit better than we thought was going to happen, a little earlier than we thought was going to happen. And so that helped us outperform our cash flow expectations for 2020. You can think about that for Gulfstream continuing to normalize this year. We'll start to see the 500s and 600s hit that inflection point and no longer be a headwind. But at the same time, keep in mind we're building up on the 700s as that. So that'll become a little more neutral this year and then eventually shift into a tailwind in the 20. The other piece is obviously the large international program at Combat Systems, which again was a headwind for several years. That turned with the modification to that contract that Phoebe discussed earlier last year. So that stabilized last year and becomes a very modest tailwind this year, and then becomes a more meaningful tailwind in 22, 23, and a little bit more in 24. So when you think about the way those two pieces are moving, that kind of gets us on a cash flow trajectory from, if you go back to 2019, we were in the 60-ish% range, moving toward an expectation of the 80% range last year. We outperformed that. And now we're in the mid to high 90% range. The one piece there that's range really is the elevated investment profile in CapEx at Marine Systems. So once that normalizes next year and gets back into the 2% of sales range, you should expect to see us, the whole business at large, being in the 100 to 100+% range. Those two working capital pieces at Gulfstream and Combat Systems becoming the tailwinds that allow us to get. That's kind of the trajectory for all those major where we're going, and the basis for our expectation for the improvement that we see ahead.
Yep, absolutely. Thanks very much.
Our next question comes from Ron Epstein from Bank of.
Yeah, hey, good morning.
Good morning, Ron.
How are you? Switching over to the ship business, into both having the Virginia class and the Columbia class in everything that they got to do in terms of workforce, supply chain.
It's going very well on both ramping up Virginia and equally importantly, more significantly, Columbia. There's something important to remember when you think about Columbia. We started 14 years ago, and in that 14-year period, we have worked assiduously with the Navy to reduce all known potential risks that we could foresee of a very complex new program. That included workforce hiring and training, supply chain readiness, construction prototyping, technology readiness, retiring potential risks in new high-end technologies. This boat entered into construction with a 83% design completion level, in great contrast to Virginia, which has been an exemplary program at 43%. So all of this prior planning and 14 years of detailed blocking and tackling at every conceivable level has mitigated enough to proverbially hit the ground running on Columbia. And note, it's a very complex program, so you can't declare victory on any shipbuilding program right out of the bat. But we have taken unprecedented and historically unprecedented measures to retire all the known risks going forward. So that has really allowed us to execute coming right out of the gates very strongly. They've done a very good job.
Got it. And, it seems like the focus on the Pacific's been good for the ship business. How's it been for Gulfstream? I mean, when you think about U.S.-China relations, has that had an impact on Gulfstream demand?
Not that we can see. So our demand in Asia has been and good. We've got a nice, large installed base, a lot of customer intimacy there. So to date, we have not seen a particular impact.
Got it. Thank you.
Our next question comes from Miles Walton from UBS. Please go ahead with your question.
Thanks. Good morning.
Good morning, Miles.
Maybe we haven't heard your thoughts on M&A for a little bit, so I was hoping maybe we could go there. Obviously, you're getting to a point on your leverage, which is getting pretty attractive, building up plenty of firepower. What are you looking at? We've been an acquisitive company. Is the appetite growing there?
So we have been through a significant investment period across many of our large lines of business, and our focus here is on execution and primary focus. We always look for potential niche bolt-ons here and there, but we don't see anything on the horizon here of any significant opportunities that would entice.
Okay. And Jason, what's the target debt ratios that we're aiming for? I know you said you'll refinance some of it, but maybe a little color there.
Yeah, I think perhaps less of a target ratio than, we're going to continue to prioritize our mid-A rating. That's always going to be sort of where we seek to land long term. And so the key for us right now is we had, as you're aware, sort of an outsized level of debt maturing this year versus if you look out over the next 10 to 20 years, what our debt ladder maturity phasing looks like. And so really what we're aiming to do is sort of bring that into more of a balanced picture of capital deployment that allows us to step down the debt over time in reasonable measures, as well as have considerable flexibility and firepower available for other deployment opportunities.
All right. Thank you.
And our next question comes from Sheila Kahyaoglu from Jefferies. Please go ahead with your question.
Good morning, everyone. Thank you. Hey, Phoebe, maybe a big picture question for you, because I know Howard always has us covered on the numbers. You've been at GD as CEO for almost a decade now and at the company for 20 years. How do you think about where GD goes over the next decade, whether from a portfolio focus or customer focus as the budget flatlines, or where operating leverage comes from that?
So from a strategic perspective, we decided several years ago to invest in a number of our significant lines of business where we believed that we could realize the best return on invested capital and really drive value. We have been in that period at Gulfstream, GDIT, primarily Gulfstream, GDIT, and the Marine Group. So the key now, from my perspective, is all about execution. And execution has been the hallmark of everything that we do here, and it is the undergirding of all financial performance. And it requires a discipline across a series of elements that are factors in all operations. But really, as I see the next several years, it's all about execution and wise deployment of capital to drive nice value creation. Ultimately, long-term value creation is based on good product, superb execution, wise investments, and smart capital deployment. So that's what I see us doing.
Our next question comes from Pete Skibitsky from Alembic Global. Please go ahead with your question.
Morning.
Phoebe, I was wondering, in combat, I'm wondering if you could give us a sense of what international orders are out there for you, maybe both, kind of sole sourced expectations as well as competitive opportunities.
So international consists of two items, primarily sales outside the United States from entities outside, from our business units outside the United States, as well as FMS sales emanating from the United States. And unfortunately, for the state of humankind, the world has become an increasingly dangerous place. The reflection of that concern in many U.S. allies with increased demand for many of our products. In Europe, a little bit in Asia, parts of the Middle East, and in the former Commonwealth nations and the UK as well. So we look for nice, steady demand signals coming from for our business units that are domiciled ex-US, and FMS. The United States' long history of providing its allies with FMS opportunities, of those in our opportunities in our combat systems, again, selling through the U.S. government to key U.S. allies positioned in particularly dangerous spots. So we see continuing in terms of our orders.
Okay. And U.S.-wise, you expect programs that you're competing for, this MPF and OMFV, you think they survive any budget tightness?
So new programs are always the most vulnerable, but the only contracted to develop prototypes. We delivered those last year. We like our offering. We think it's what the Army wants, but we're very attuned to Army demands and how they see their fight, and that's where intimacy with the Army helps significantly. So with OMFV, that program got stretched considerably. So we are waiting, but there's a long way to go before that comes to fruition. But recall another element and a key element of Army modernization is upgrading with important and existing platforms. And for us, that means Stryker and Abrams, and both are undergoing major upgrade programs. So all in all, for our programs, continuing to go strong. And there is nothing like, going back to the earlier comments about execution, there's nothing like performing on schedule and on budget to amplify and provide a bit of an antidote to any potential cuts that come in. That is the Army's major integrator of combat wheeled systems and will remain such. So that ensures that our place in the firmament remains pretty strong.
Right. Thank you very much.
Question comes from Peter Arment from Baird. Please go ahead with your question.
Yes, thanks. Good morning, Phoebe. Jason. Hey, Phoebe, a question on the budgets, I guess, just kind of following up on the skinny budget from the new administration. But how are you thinking about just the alignment with the new administration priorities when you look at?
So clearly, as Ron mentioned, the demand for products that meet the Pacific Theater have shipbuilding business instead, and you can funding supporting increased submarine production, and we are executing record and working with the Navy to see how additional submarines can be executed in a relatively short term. Our combat systems group, fortunately but regrettably the case, the hottest theater at the moment is Russia. And so whether we like it or not, that is the reality with which we are faced. And this administration has been very quick to respond appropriately to the Russians. And so you see, we believe that combat systems is highly a reality that we're now faced with in Europe. So all in all, we like our positioning with the new administration's priorities. Remember, and particularly administration and this president has been an advocate of strong national security throughout his long and distinguished career. U.S. national security strategy is driven by the threat or the perception of threat that has not changed. So we'll see priority among systems, but in all instances, we see ourselves very well aligned.
And just as a quick follow-up, something that doesn't get talked a lot about, but you have a lot of cyber capabilities. Maybe you could just give us a little color on how you see the opportunities there. Thanks.
So if you mean from both cyber is embedded in all of our business, and if you get to what I think you referred to as PSYOPs, it would be the height of folly to discuss any of that. But let's just put it this way: we have always been on the leading edge of innovations with respect to cyber and electronic technologies that apply to the real world fight in the moment.
Appreciate all the color. Thanks, Phoebe.
Our next question comes from Richard Safran from Seaport Global. Please go ahead with your question.
Phoebe, Jason, Howard, good morning. How are you?
Morning.
First question I had is I was interested in the announcement, and I think it was back in February, where at IT you added Amazon Cloud Services to the MilCloud 2.0. What I wanted to know was, how much does the addition of Amazon enhance your offering? Was this something that, just improved the cost on the program, or is this something that maybe opens up new opportunities for expanding cloud service to the government? Just anything you can tell us regarding the size of the opportunity or what this does would be appreciated.
So, not surprisingly, the U.S. Department of Defense is moving as all major institutions are increasingly to the cloud. And so our cloud offerings are an incrementally important part of our offerings that we believe will ultimately drive increased adoption across our existing contracts and adoption of the technology suite that we offer. And frankly, an expansion of the market. So cloud presents a significant opportunity, and we are well positioned to execute on it.
Okay, thanks for that. And then second, and just a kind of a broad strategic question for you, and your comments about execution. Over the past year or so, you've made a number of changes to adjust how you're operating. I was just wondering, what are the more permanent changes in how you operate and, that are going to persist long after, COVID? I was just how you're thinking about that impacting and improving margins.
So let me infer a little bit from the question you're asking. We hear a lot of anecdotal evidence that there may be systemic changes emanating from COVID that have to do with work at home and what that might mean for commercial real estate footprint. We still believe it is too soon to declare any change structural. We do expect to see some, the extent to which remains to be seen, but some work from home, either in hybrid capacities or in some cases more completely. But I don't see that move as something that is dispositive and determinative of real performance and execution. I think what you saw in going back to execution through COVID and frankly this company's performance across its business units during COVID was really a manifestation of the discipline that we have in all of our operating performance and our operating leverage. The more disciplined a company is, the better they were able to adapt to the vagaries and some of the really significant challenges that COVID provides, and frankly to customers and the environment. So I think that to me it underscored, amplified our operating excellence. And I suspect that will continue, an understanding of that will continue to permeate as we go forward, and we will continue to build on that. Operating excellence is never static. It has to get better and better and better. That's what continuous improvement is all about. And frankly, we have a long-standing discipline around that. So I don't think there'll be a structural change in our operating performance, but it simply undergirds the importance of that discipline that focuses on performance.
And Jamie, will please.
And our final question comes from Robert Stallard from Vertical Research. Please go ahead with your question.
Thanks very much. Good morning.
Morning.
Phoebe, just a couple of quick ones on the aerospace strong first quarter here, but I was wondering if you had seen any demand pulled forward into the first quarter from the second quarter. And then secondly, we talked the lead time for aircraft looking? Are we still looking at roughly 12 months between an order and a delivery? And also, how has pricing fared in the first quarter? Thank you.
So think about demand. Demand comes when it comes, and you execute it as it arrives on your doorstep. So what we saw with respect to demand is starting, as I noted, in mid-February, we saw a nice steady increase in demand across a broad spectrum customer base, and the U.S. Initial estimates show, or indications are, that demand is carrying through into the second quarter. Is holding up very well, as you well know. It is precious once lost. You don't get it back, not without a hard slog. So pricing has done very well, and we'll, as I noted earlier, it's about 6 months to ramp up additional production, and I don't see that interim significant given all of the elements that have to perform. So I hope that answers your question.
Yep, that's very helpful. Thank you.
Operator, thank you very much, everybody, for your time, and I will be available to be reached in my office. Thank you very much.
Call, we do thank you for attending. You may now disconnect your